It was partly prompted by its belief that the launch of a Bitcoin futures ETF would be too costly for investors that Invesco abandoned its plan to launch it in the US last month, just hours before its New York debut. The $1.6 trillion asset manager shelved plans for the launch of an ETF tracking Bitcoin strategy, with almost $1 billion of shares trading hands on its first day of trading. The Invesco ETF would have been the second such ETF to go public within 24 hours after the ProShares Bitcoin Strategy ETF, which was the second strongest debut in history. Assets of BITO currently amount to $1.3 billion. Invesco did not pursue the ETF despite putting forth the 69,000 words, 75 pages of documentation. According to Atlanta-based company, concerns over future cost and suitability for investors were a factor in its decision. Bitcoin futures, known as contango, incline upward generally, meaning funds incur losses when rolling a front-month contract into a longer-dated one. One of the roadblocks was the realization that the SEC was only considering allowing ETFs with a 100% exposure to Bitcoin futures. We thought CME futures would be a very valuable addition to the portfolio. Anna Paglia, global head of ETFs and index strategies at Invesco, said they were never expected to be effective at 100% of the product. Instead of physical Bitcoin, Invesco preferred futures, swaps, ETFs, and private funds investing in the Bitcoin industry, as this would protect investors should a liquidity crunch occur. Paglia explained that the inability to accomplish that was a driving factor behind the decision. We discovered that by further examining the market in the space, there might be more effective ways to provide this kind of exposure instead of offering something that was not aligned with what investors expect from us. Paglia said that after running a number of simulations, the cost of rolling the futures resulted in a drag of 6 to -80 basis points per month. Our annual growth rate is going to be 5-10%. She cited capacities and liquidity concerns for the futures market as well as concerns about replication of the index without significant tracking error. He said Invesco filed for an ETF based on regulated Bitcoin futures traded on the Chicago Mercantile Exchange within 24 hours after the SEC chair indicated he supported the idea of a futures-based ETF. ETF applications based on holding physical Bitcoins themselves have continued to be rejected by the SEC, which considers Bitcoin a market susceptible to fraudulent and manipulative practices. The fact that Gensler's statement came out just 24 hours after we filed was crucial for us, which is why we did so within 24 hours, she explained. At the time by which Invesco conducted the study, it was only after the filing was filed that Invesco began to do a deep dive to determine if the product would affect investors in a positive way, Paglia said. Before pulling this filing, we carefully thought about whether to do so. As a result, we are aware that people will ask questions and will scratch their heads afterward. Choosing to say yes and see how the process works were much easier than choosing to say no and explaining my decision. Making this difficult decision and taking responsibility for it is something that had to be done. It was among the other firms to withdraw a filing for an ETF based on futures. Bitwise Asset Management manages $1.7 billion in crypto-related assets. It is somewhat unusual for us to file, said Matt Haugen, a chief investment officer. Our filing requires a substantial amount of legal, intellectual, and business alignment work. The decision was based on two factors. According to Haugen, when Bitwise filed, the product would have more flexibility in terms of how it is constructed without the need for a Cayman Islands subsidiary and with the option to treat spot Bitcoins alongside futures without creating a Cayman Islands subsidiary. Asked to comment on this statement, Haugen explained that the success of BITO in collecting assets was outpacing that of futures commission merchants, who accept or solicit orders to buy or sell futures contracts and which have responded by raising prices. According to Haugen, an ETF backed by futures would be imperfect because of the way futures work. The costs are so onerous that in the end, we decided it didn't serve the interests of long-term investors. He believes futures-based exchange-traded funds are fine if you are making a short-term bet. The market currently offers better opportunities for long-term investors, Haugen said. Ultimately, we want to get a spot ETF on the market. A spot-based ETF will come to the US eventually. we won't still be asking that question in 3 years. Invesco said it was focused on alternative ways of offering exposure to cryptocurrency.